trust no one. Today, we're going to talk about how Wall Street and Bay Street analysts and brokerages and the media are notoriously wrong at telling you that the market's going to rip or the market's going to dip, always at the wrong time. At the end of this video, we're going to cover where the street stands right now and what I think is the reality behind today's markets. Let's get started. The first thing we're going to look at is the National Association of Investment Managers' participation in the stock market. In other words, how invested they are. A reading of 100 would be portfolio managers on the whole are fully invested in the market, and a reading of 20 would say that they're 80% cash and 20% invested, which is very rare. What we're going to find is that portfolio managers are just as susceptible to emotions as retail investors are. It doesn't mean we all are. In fact, Value Trend prides itself in being contrarians, but the group as a whole is just as dumb as all dumb money. So let's take a look at what I mean. Let's look at recent history. We can go way back in history and you'll find this pattern repeats, but I really just want to look at the past couple of years. So this is, if we look on the chart here, I'm going to zoom in just a little bit. This is 2022, and you guys know what happened in 22. The market fell. Well, what happened leading into 2022 was portfolio managers, which includes brokerage portfolio managers, large institutions, and the independents like myself, on the whole, were bullish. They were fully invested in the market. In fact, because some hedge funds and whatnot leverage, you can sometimes see the percentage invested by portfolio managers go over 100 because they'll leverage sometimes. So they were easily hanging out in the near 100 zone for much of 2021. What happened? The market fell. Well, guess what happened? When the market fell, which is the time you want to buy, so this was not the time to buy, when the market hit its bottom right there, where was the lowest percentage point of participation by portfolio managers? Son of a gun, they were down to like 15%, right at the bottom. Okay, so another example, 2024, portfolio managers were somewhere near, very close to 100% invested in the market. Market fell and they reduced their positions. Now they didn't go extreme, but they still reduced positions. They've already started picking up, and that's maybe a sign of warning, because as portfolio managers on the whole, not Value Trend, moves in aggressively, that's indicating that they still haven't given up. And you want capitulation by everybody, including the professionals, before you want to step in for the ultimate buying potential. Now I want to go into some historic examples of when the media and the street and portfolio managers were optimistic and ever increasing their outlook for higher highs and extremely bullish markets. Best example I can think of in my career, and I started in this business in 1990. Well, you guys might remember the tech bubble. Well, what happened is Nortel is what happened. And in 2000, Nortel peaked very close to $200 a share. At that time, and I can tell you because I started 10 years before that point, and I remember that everybody was talking about Nortel, world leader, internet, bandwidth, all that stuff was being bantered around, very much like AI is being bantered around today. And everybody had to be in Nortel. In fact, I was a stockbroker at the time. I was not a portfolio manager, and many of my clients actually pressured me into owning Nortel. And I have one story, I think I've told it in the past, that I took on a client who worked for Nortel at the time, and he had 3/4 of his portfolio in Nortel, and he refused to sell any of it. Thankfully, he kept it in his own account at an online brokerage, and you know the story. Well, this is the story. So why were the analysts, the professionals on the street, touting Nortel to go higher and higher? Well, because they're crowd followers, as we just saw. Great example being Nortel. Let's fast forward a little bit to 2025. Now, I could give you a lot of examples beyond the Nortel example to show you how the street has been positive on stuff right at the very top. But I want to kind of look at 2025 January consensus. And what consensus is when we take the street, all of the analysts on the street, and they give their outlook for the year. And consensus for the street was $269 in earnings on the S&P, and they were looking for basically a 13% upside from January 1st. So that's very interesting because the market so far has been almost halfway through its year, and we're nowhere near 12, almost 13% upside. In fact, we haven't even recovered to the high. Another example of media and street exuberance has been Nvidia. Now, if you guys watch my videos or read my blogs at valuetrend.ca, you'll know that I was talking about Nvidia in the last quarter of 2025. And it wasn't just Nvidia, it was all the AI stocks. And I felt that they were overvalued, but I was particularly picking on Nvidia because it really had shot so high. This chart sort of shows you, here's 2024, and up like a rocket it went. I mean, it went from around 40 bucks a share to around, well, at the top, around $140. So that's quite a jump in a year. Well, I felt it was very overvalued, but interestingly enough, and I'll delete a couple of my lines here, the street at this point, very beginning of 2025, 37 of 42 brokerages had strong buys, not just buys, but strong buy ratings on Nvidia. Shortly after they gave those ratings, the stock fell. It's recovering a bit right now, but not even near where it was at the beginning of January. Time will tell if they're right, but it doesn't look so favorable for the timing of their issuing strong buy recommendations, especially at the top. Now, here's an example of a stock that has been shattered over the past week or two. And you might know the name, UnitedHealth. UnitedHealth declined, as you can see on the chart, from some $600 to recently $300. That's a 50% haircut. And for a bald guy to be talking about haircuts, this is a sensitive subject. So I saw a report come out by Bank of America, the largest brokerage firm in the United States, and they reported that they want to downgrade the stock. This week, they decided to downgrade the stock. Up until this point, it moved from buy to hold. Now that it's been cut in half, they've downgraded it. How do you guys feel about brokerage recommendations so far? Let's bring us up to date. You guys probably know that about a week ago, Trump met with China, or at least his people met with China, I should say, and they hashed out the beginnings of a tariff deal. On that talk, after the weekend, you see the market gapped up. Whenever we see a space between the close of one day and the open of the next day, that means it's a gap. The price didn't even get to open at the same price it closed at. It gapped up. This is a sign of exuberance. Now, gaps often end up being filled, as they say, because there's signs of irrational activity, overexcitement, and they often see a rally and then a decline right back to the old gap point. Why does that happen? Because that gap represents a moment of perhaps irrational exuberance. Well, it doesn't always happen. Sometimes we get a gap, the market moves up and just keeps going. But just be warned that this can often happen. So let's take a look at some of the factors behind why I think we maybe should still remain cautious, although I will say that Value Trend expects to continue legging in so long as the market holds above the 200. We're going to do it very cautiously though, and I'm going to show you why. Well, going back to our media news, Citibank, another large American bank and brokerage firm, just announced that they feel that the Trump tariff de-escalation is more bullish from the market than expected, and they expect this to boost stocks. Well, over the past few days, they're right. The market's gapped up and moved up 2 or 3 days. But the question is this sustainable? Because I'm sure after Nortel analysts gave their buy recommendations, the stock moved up some more before it didn't. Now let's take a contrary look to the stance taken by Citibank that the market's going to go up, up, up because of this tariff talk that's happened with China and the recent talks with Europe. This is some quotes from David Rosenberg, a Canadian economist, and I thought they were interesting, so I thought I would print them here, and I wanted you to take a look at them. So he's saying that it seems unlikely that China will accept the offer that they were given over the weekend as a final arrangement because it would be perceived that Trump is getting the better of Xi, and I hope I said his name right. So the point being that this is early for the market to get excited, because I wrote a blog the other day, and I would encourage you to read it. Click the link below. And I talked about this exact quote and 3 scenarios that could happen. Basically, we get lower tariffs, which is still only marginally good, or mid-level tariffs that were kind of in line with what he announced a few weeks ago for Europe, which is not that great, or really bad, expensive tariffs, which would be horrible. So there's really a potential for this market to reverse if any of the negotiations turn out anything other than the perfect scenario. I want to give you one more quote from David Rosenberg, and that is that the UK tariff talks went over without a lot of bang, and that is that they had already been working with a 10% tariff rate, and after Trump met with them, they kept the baseline 10% rate. So there was no real progress. Trump wanted 10%, he got 10%. So there weren't a lot of concessions. There were, as he says, a few token concessions in different sectors, but for most countries, as says Rosenberg, this is discouraging because Europe was looking for a better deal and they didn't get it. So any of this stuff comes out as the tariff talks go forward, and you're going to see the market reverse. So don't believe the media. I wanted to now mention that I am on BNN television on Thursday, May the 22nd at noon. You can watch the show and you can call in during the show. And that's the one time you can ask me about a stock and I'll give you my 2 cents worth. I can't answer stock questions on these videos, but I can answer on BNN. The other show that's coming is I'm doing a presentation for the Money Show on Wednesday, May the 28th at 9:30 a.m. You can go to my blog that I just mentioned. Again, click the link below and you'll see a way to register for that. It's free. It's about half an hour. And again, you can type questions as I'm doing the webinar. I'm going to talk about my current market outlook. And by the 28th, I'm sure the market outlook will be a new refresh because things move so quickly these days. So be sure to catch me on BNN next week and try to make it to the Money Show presentation webinar in a couple of weeks. One other thing I want to talk about is I mentioned a couple of weeks ago that we are trying to get to 20,000 subscribers. Remember, my associates bonus is based on you guys bumping the Value Trend subscription base to 20,000. So make sure that Rebecca gets a raise. Please like and subscribe. Thanks for watching. Hey, thanks for watching. I hope you got value out of this episode. Please like and subscribe below. We're trying to grow the channel and it would really be doing us a big favor. I'm presenting ideas every week on trades that we're actually looking at Value Trend. And by the way, I don't just talk the talk, I walk the walk. I have been a portfolio manager for 35 years. And in fact, I was one of the very early pioneers in technical analysis here in Canada. On my website, valuetrend.ca, you will see a link for our online trading course. And this course is a complete money management system. I do encourage you to take a good look at that and consider taking it. I priced it extremely low because I want retail investors, that's you, to take the course and get value out of it. It's literally my 30 plus years of experience put into one complete step-by-step course. And honestly, I wish that I had had something like this when I was an early investor. It really will stop you from making so many mistakes. I also suggest you subscribe to our Never Miss an Opportunity program, which is our blog and our newsletter. There, you're going to get ongoing ideas, tons of charts, lots of trading ideas. And by the way, we never, ever solicit. We don't send you junk spam and stuff like that to try to get your business. It's for information, because part of my passion is to teach retail investors how to invest properly. I've been doing this, as I said, for 35 years, and I hope that I'm able to pass on some of the things that I've learned through this career as both a pioneer in technical analysis in Canada and a longtime portfolio manager. Thanks for watching. Don't forget, push like, push subscribe. See you next time.